Expanding into a new geography is one of the quickest and efficient ways to gain access to a new potential customer base. Correctly integrating your business into that new economy is critical for your company's success. If it's done incorrectly, it can result in massive legal expenses, wasted capital expenditures, as well as regulatory issues, which could truly make or break your company's long-term success. Thank you for joining us today. My name is Colin, alongside me are my colleagues, Monroe and Stephen. Together we represent Etsu Consulting. Each of us have an expertise in background, assisting companies such as yourselves integrate into new economies and perfectly set them up for long-term success. Just an overview of our presentation, our executive summary. The key issue that we're discussing with you today is how should Orbis expand into the Japanese market? So there's recently developments that have happened in the Japanese market that have made it very attractive for your company to begin to enter into that. Some secondary issues are, how are we going to finance that entrance into that economy? Determining where we're going to source our capital from and how we want to proceed with that, as well as it's a highly regulated industry with major headwinds that could hurt your company moving forward. And additionally, your company, although it's globally well diversified, it doesn't have any Japanese experience in that particular market. Our recommendation here is going to be acquire target securities code, which we believe will perfectly set your company up for long-term success, as well as become profitable even immediately.
And so before we dive into an analysis of the alternatives as well as an implementation plan, it is important to have a solid understanding of your organization as well as the marketplace that you're going to be entering. So to begin with, an organizational analysis. Some competencies of your organization include an attractive fee structure. So your organization does not charge any fees as well as no commissions. However, you do take 50% of any above a market valuation. So whenever your investments reach a certain point, they take 50% of their profits after that. This is incredibly unique and is not offered at all in Japan, which gives you an excellent opportunity to take advantage of. As well, international experience. Your company is currently operating in 9 countries with over 400 employees. This means that you fully understand how to move into new economies and new markets. However, some challenges is your organization has no previous experience in Japan. Japan has some serious regulations on licensing for investment companies, and without any experience, we'll need to consult on that as well. And an analysis on the Japanese market, some competencies. The demographic currently has 38.1% of people between the ages of 25 and 54. This is a perfect range of people that are looking to invest in mid to long-term investment plans, which lines up exactly with what your organization does. There's also a change in the real estate investment market. The assets under management in Japan has increased 22% since 2008, which was the market crash, as well as there's been a new development with the 2014 NISA tax-free investment system, and this system strives to stimulate mid to long-term investments for people between the age, from above the age of 20. This lines up perfectly with the demographic, the large portion of the demographic, which is an excellent opportunity to take advantage of. However, some challenges within the Japanese market include cultural differences. We have never operated it in this market, so we'll have to learn the cultural differences between us and the Japanese market. Also, it's a heavily saturated market. There's 250 firms that are directly competing with us, so we need to offer something above what they do already. As well, there's extensive licensing regulations, as I discussed before. So these licensing agreements are under JDSA, and they are a self-regulating organization that is responsible for all of the licensing. And licensing involves a 1 year without any experience, a 1-year training program, or you need at least 3 years of experience dealing with the licensing. So if we do an acquisition, we will have to either wait, we will have to hire people and wait for them to get approved for licensing, or keep their staff on.
As Colin sort of mentioned earlier, the driving issue that's facing your company at Orbis is how to expand into the Japanese market in the most effective way. And a couple of the secondary issues that sort of derive from this is how to financing it and how to finance the project. No matter which alternative that it's decided upon, it's going to require capital to begin and actually commence. The second is a high regulatory system. As Stephen has mentioned a couple times now, Japan's a very highly regulated market that needs to be taken into consideration when choosing an alternative. And the lack of experience in the Japanese market is going to be another driving issue of how to actually effectively expand into this market. Although you do have international experience, it is another thing to consider that there are different cultures no matter where you go. In Japan is no exception. You have no specific experience with the Japanese culture. So, to solve some of these issues, when we make any recommendation on any consulting job, we look at decision criteria. So this is our ETSU approved criteria. We look at it on a case-by-case basis. So what we've identified for you is the 3 decision criteria when choosing alternatives. The first is it needs to be true to organizational philosophies. Your company has extremely rigid organizational philosophies, and this is a big strength of yours moving forward. Not as many companies have these tight morals that you stick by, and it's going to be a key to success moving forward. So being true to them is crucial. Second is having the highest NPV. We'll analyze a few different alternatives, and of course they're all going to have different values. So we're going to recommend the one with the highest net present value. And lastly, it has to be sustainable in the mid to long term period. And this is simply because this is what you identify as one of your growth strategies, one of your targets, something you mentioned to us when you first contacted us.
So some of the alternatives that we looked at when evaluating the current issue is, our first alternative we came up with is a strategic partnership with Target Securities Co. Our second was a greenfield operation, and lastly, our strategic recommendation was an acquisition. So starting off with our strategic partnership, we would recommend to partner with Target Securities Co. So this would involve approaching their board and management and introduce a product along with them, and then there'd be a revenue split. So the pros of this is there's minimal capital would be required. We would use the resources associated with Target Securities Co. to introduce your global equity fund as well as the global balance fund. And they already have experience in the market, so they're familiar with the Japanese culture, and additionally they already have the licensing requirements. And some of the cons of this is you wouldn't have that lack of control, something that your company has thrived on and it's become enculturated in your company as part of your true philosophies. And there's also potentially misaligned interests. We don't necessarily know how the management and board will approach something like this and what type of deal, as well as legal expenses that would result from it. And it doesn't have the highest NPV. However, in the mid to long term, after getting past the short term of negotiating with them, it would be profitable in the long term. It's just not the most profitable option for you today. Our second option is a greenfield operation. Start a new company in Japan. So this would require licensing, which would take up to 1 year. Additionally, this would require a $1 million capital injection in the form of networking capital, and $150,000 in legal costs, as well as that time delay before you're actually able to set up and integrate the investment funds that you offer clients. So the pros are you maintain your philosophy. There would be no issue jiving with another firm moving forward, as well as this one doesn't necessarily have the highest NPV. Some of the cons of this are also the long-term forecasts. So we don't necessarily know how your company's brand will do without being established in the Japanese market. So the sustainability of it over the long term, it's extremely difficult to forecast. So in that regard, we don't necessarily know if it's going to be the most profitable outcome. However, our strategic recommendation to you is going to be acquire Target Securities Co. So based on our financial analysis that we'll show you in just a second, Target Securities Co. is trading at a huge discount to net asset value. So our offer would propose 12.19 million Canadian, which would represent a 15% premium over their current market value. This would be in the form of an all-cash offer, which we would finance through debt, which we'll just discuss in our implementation. So the pros of this is there's lower licensing costs. We would leverage the licensing approval that has already been received by Target Securities Co. And also this short startup costs. So because they already have the licensing requirements, we'd be able to immediately integrate the Global Equity Fund and the Global Balanced Fund, which would give investors the alternatives to choose between low risk as well as a higher risk, higher reward investment strategy. Some of the cons of this are the integration costs. So there likely would be some headwinds moving forward, integrating your company culture with theirs. However, we believe that the performance-based incentives that you offer right now would be more than attractive for the management team at Target Securities Co. So this, we remain true to philosophies, we maintain ownership, as well as you be unique in entering into this market, and with also additionally, with the type of fee structure that you offer your clients is one of the most competitive and unique that we've seen. Some of the cons, additional cons, the differences in cultures. So some of the major driving costs would be initially within the merger. So based on our financial analysis, what we did is we looked at Target Securities Co. on an independent basis as a standalone firm prior to investing any sort of investing revenue from your new funds. So even under a very conservative growth estimate of -5% in the revenue, this would generate net income across the board of 88.7 in 2021, which is our forecasted. However, more importantly, the free cash flows that this would generate, based on our DCF analysis, this would imply an estimated firm value of 1.2 billion yen, which is based on the current enterprise value of 982 million. It currently trades at a 19% discount to face value under our extremely weak assumptions. So based on a stronger assumptions, just assuming a conservative 5% growth in revenue, we go through the same place. We assume a similar percent of sales for tech communication equipment, same sales as well as general administration expenses, which arrives at a net income in the 2021 of 147.5. So more importantly, the free cash flow analysis from this generates an estimated firm value of 2.2 billion yen, which is a 57% premium. Sorry, so that should be just over 100% premium to the current market value. So what you're really focusing on is how would your firm look integrated with this firm? So based on new investment products, we estimate that these are fairly conservative estimates. We estimate that you'd be able to generate an additional 5 million in revenue from the fee structure that you have in your current investment products, because we believe that these products will be highly demanded because they're some of the most competitive pricing that we've seen. So this would result in free cash flow analysis, estimated firm value. Because we grew revenues of the company at a lower rate, this resulted in a slightly lower value of the 5%. So it would still represent more than 100%. The firm's currently trading at more than 100% discount to net asset value.
Going back to the three alternatives again, this is just sort of a quick summary, just to refresh your memory of what we've done as a recommendation. As you can clearly see, one stands out as checking out all three decision criteria boxes, and that's acquisition. It's true to your philosophies, it has the highest NPV, and it's completely sustainable in the mid to long term. And that's why it's our strategic recommendation to acquire Target Securities Co. The impact of this is that you're going to be poised for strong results in the mid to long term, which is what you've identified as one of your strategic goals. So moving on to the implementation phase. So how are you going to move this project forward, and how are you actually going to make it a reality? We've identified three different phases that the implementation is going to work between. First is the acquisition phase, followed by the integration phase, and the operation phase. And I'm going to walk you through these one at a time. Beginning, of course, with the acquisition phase. So the first thing that needs to be done in the acquisition phase, where you're going to be acquiring Target Securities Co., is consulting a legal team. With any acquisition, there's going to be a ton of legal necessities. And one specific one we've identified is specializing in Japanese law. This legal team needs to have specialization in Japanese law. That's simply because this is going to be in Japan. This source of your business may need to be outsourced to find the ideal legal source, because without proper legal representation and counsel, then this entire deal may fall through. So the cash offer is going to be through the debt financing. As you see through the EBIT or the interest coverage, you're completely covered to finance this debt. You can finance your interest payments, and it should be no issue to take on this debt. So after the financing has been determined and the legal team's been consulted, you need to reach out to the board and the management and actually make the offer. And reaching out to the board is incredibly important in this, because as Stephen Colin mentioned earlier, paying a premium for this, and this is going to benefit their shareholders. Developing a flexible business plan is crucial in this step. This is simply because moving forward through the integration and through the operation phase of it, this business plan is going to be crucial to your success. The last thing I'd like to touch on is creating a cutoff point. This cutoff point is going to be in the future once we move into the operating phase. If target revenues do not reach a certain point or operations don't reach a certain point, to cut off. But something unique about we like to talk about for your cutoff point is we like to include that in terms of philosophical standards. So if at any point the philosophies of your business aren't being met, then cut off the project moving forward. So the strategic goal of this phase is to acquire target securities company, and the measure is going to be an approved offer very easily. Moving down to the integration phase. The integration phase is the phase where the two companies are going to be amalgamating into one. And one of the key points of this phase is integrating that business plan that I aforementioned. Two areas of largest concern with that business plan are going to be the branding and reaching out to the target market. So with branding, will you be operating under your name or Target Securities Company? And the target market, will you be going after the 25 to 55-year-olds? Next is employee management, is the other key issue or the key point of this phase. 3 to 4 licensed employees need to be on hand at all times. And no, legally it's only 2. We recommend having 3 to 4 through this phase because through the integration, some people may decide they want to go, they may look for other jobs. It's a risk that you're going to run into. So having a few extra on hand is crucial. One of these at least has to be local. And this is simply to integrate or to help you understand the Japanese culture a little bit more. Acquiring more licensed employees is the next step. That's going to be training and creating some of your personal already existing corporate employees and getting them licenses so they can effectively operate in Japan as well. There's going to be HR focus in this phase too, simply hiring and firing, determining which of your employees want to move to Japan and determine which Target Securities Co. Employees are going to need to remain or leave. Strategic goal in this area will be the successful acquisition. The measure is the demand for new investment products. So it's creating the creating the business plan and integrating that, creating the demand. The last phase we have is the operational phase. And this is where you're going to be executing your business plan that you've been developing and now integrating into the new company. So this is where sales are going to happen, and this is where you're actually going to be releasing products. An important step is to evaluate the implementation. So in case of moving forward and potentially moving to other different markets, having an evaluation of how this went can improve the process further next time. So constant monitoring of operations and philosophies against the cutoff point. This is simply to know if it's being profitable or if you need to abandon the investment. We see a very low probability of this, but it's important to have this mitigation in hand. The strategic goal of this is going to be integrating into the Japanese market. The measure is just going to be mid to long-term success, which is what you've identified as your goal.
And as we said, any acquisition and implementation plan, there is some serious risks that need to be evaluated. So first and foremost, we have the market compatibility with our organization, your organization, and Japan. However, this is mitigated through the NISA agreement as discussed. It is right in line with your business, as well as we have a clear target market with people from 25 to 54. Also, there is the risk of the misaligned cultures, and this is mitigated through the integration, allows for cultural adaptability. So when we do move in and acquire the firm, we will be keeping on some of the employees that have experience within the Japanese culture and learning from them. As well, another risk is the higher than expected legal costs. We are going to use existing employees' licenses in order to help reduce this cost, as well as we have an experienced Japanese legal team to help us get around some of those tricky loops. And so just in summary, once again, our recommendation is to acquire Target Securities Co. And the impact is going to be poised for strong results in the medium to long term. And we'd like to open the floor for any questions.
I know Target has, aside from their main businesses, which are similar to ours, I know they have operations in leasing and in non-life insurance. So what do you guys suppose we do with those businesses that I would say are not core to what we do?
Definitely, they're not core to what you do, that's correct. And what you would do with those businesses depends on the diversification and the profitability that those actually contribute to the underlying success of Target Securities Co. So more due diligence would be required and a deeper breakdown done to determine the exact revenue as well as the net investments generated from those businesses. And then from there, determining how to dispose of them, finding a potential buyer for them would be done in the mid to long term.
We've identified that only 38% of the Japanese population is likely the target market. Is that a concern that such a small portion of the population is eligible or more likely to use Orbis' products?
Absolutely not. It's one of the fastest growing areas of the population for one. The 38% segmentation rate is absolutely fantastic when appealing to products. In general, the benchmark for this is about 20%, so having 38% is absolutely astronomical.
In term, you mentioned when we were talking about the financials and just part of the rationale in terms of going after Target was that there is a pretty big discount on all main metrics listed and what we've been given so far about its price. Any thought in terms of, you know, and we're in the early stages of potential due diligence, but any thought as to why that might exist right now? You know, and also looking at kind of the 5-year track record, we had a huge drop in revenue at that company. The 1 year. So any worries that you guys have in regards to that?
Market optimism is strong, so it definitely appears to be just sort of unfavorable look towards the stock, which has led to the underlying business. However, the net income and the sustained revenue increases are highly profitable, but more importantly, the business that we're purchasing already has the licensing and regulation costs, and that should be the major concern, and then we can purchase them at a discount. So the revenue that they're currently generating and also the discount that they're currently trading at is not the main priority. The main priority is gaining that legal advantage because they already have their Type 1 license.
Given that our revenues only earn when our funds outperform the market, I know in a projected scenario, you have new product revenue increasing for 4 or 5 consecutive years. Are there concerns that our company might not be able to beat our benchmarks for that extended period of time? Would that cause some problems going forward in terms of meeting those projections?
So because management and the clients both have the same end goals, we definitely choose investments that are our most strategic investments and that are most likely to be profitable.
Additional, just to add on to that, if you're referring to the cyclicality of the economy, and that's how your fee structure is based on outperformance of the specified index. You'd still outperform it even in a down year. So if the economy is not doing very well, and the index that you're tracking is not doing very well, your fund just has to do relatively better to that index.
I know I appreciated the detail in which you kind of put us up, or put out the cash flow numbers and walk us through that a bit. The purchase price, I think it was $12.19 million. Is that that's what you're saying, the purchase price?
Yeah.
Can you just clarify real quick? You may have said it, but just clarify how we get that number.
So the 12.19 is a premium, a 15% premium above their current enterprise value of 982. So that's 982 million yen, which correlates to estimated NVL of 1.129 billion yen. So it's derived from that based even under the weak circumstances, the value that the firm is at. So it's still profitable, it's still less than the estimated value of the firm, but however, the premium is still large enough to be attractive to the management and the shareholders in the Target Securities Co.
But
That's all the time we have for questions.